We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. The goal of this series is to help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. Hi, I'm your host, Bob Powell. I serve as the editor of the Retirement Management Journal, which is published by the Investments and Wealth Institute, and I also serve as the editor of Retirement Daily, which is published by The Street. Today, our topic is the death of the 60/40 portfolio, and our guest is Tony Davidow, the chair of the Editorial Advisory Board of the Investments and Wealth Monitor. So welcome to the podcast, Tony.
Oh, it's a thrill to be here with you, Bob.
Thank you. Before we get started on our discussion, for the benefit of our listeners who may not be familiar with you and your work, do you mind just giving us a brief overview?
Oh, absolutely. I'm currently the chair of the Editorial Advisory Board for the Investment and Wealth Monitor, but I've been an active participant in the Investment and Wealth Institute in speaking at conferences and publishing content for probably 20 years. So I've been very involved with your organization.
And it's been an incredible contribution, I must admit. The job that you've done with the Investments and Wealth Monitor is just incredible. So hats off.
Oh, thank you. Thank you.
So today, the subject of our discussion is something called the death of the 60/40 portfolio. Do you want to sort of talk a little bit about the history of the 60/40 portfolio first before we talk about its death, the life and times of the 60/40?
I hate to start with a negative topic, the death, but maybe we'll just say the evolution of the 60/40 portfolio.
Fair enough.
But I think you're right to really kind of take a step back, because we have to remember why we started with this notion that a 60/40 portfolio kind of made sense as a starting point. And I think for many individual investors, we tried to model our behaviors after successful institutions. And many successful institutions over the years use the 60/40 benchmark as a starting point. And the expectation was your 60% allocation to equities would get you the long-term historical average, roughly 10% return. My 40% allocation to fixed income would give me all the income that I would require, whether it be for retirement or any other sort of funding need over the long run. But that 40% income would provide significant income. And then from time to time, we'd hold a little cash in our portfolio to provide a little ballast. But the demise of the 60/40, or the re-evaluating of the 60/40 portfolio, I think comes from one of the basic assumptions, which is, what if those numbers aren't in fact reflective of what we'll see in the future? And I think that's why I have written about this probably for the last 5 years, and others have questioned the merits of the 60/40 portfolio. Clearly, as we're sitting here in the middle of the coronavirus, which is a exogenous shock to the market, we question whether having an allocation of 60% to U.S. stocks and 40% to aggregate bonds is enough of a diversifier in the portfolio.
So if the 60/40 portfolio worked at one point, there are now certain limitations or flaws that have become evident because of the capital market expectations changing and just everything changing.
Exactly. And again, I think there are limitations with it. It certainly served investors well for probably the 80s and the 90s. Most people thought they were doing just fine with a 60/40 allocation. And in fact, some of the people allocating 60% to equities might have started to think about allocating more broadly to include international and emerging markets, and those allocating 40% to bonds were probably thinking beyond just treasuries and corporates, and we're starting to use other allocations. But I think in the simplest form, clearly the 60/40 portfolio has a number of limitations. And again, I'll go back to the basis of it was, I expect to get a certain amount of return, and I expect to get a certain amount of income. And that combination of stocks and bonds have historically provided a pretty good ballast to one another. There's historically they've had low correlation to one another, and therefore when one is doing well, the other is doing poorly, and it provides a little bit of a shock absorber to the portfolio. What we've experienced recently, though, is most capital market expectations that I look at, and I know you look at similar sort of results across the industry, suggest a much lower equity return. And clearly, we live in an environment now where we're looking at the 10-year below one, and we see income at generationally low levels. So we're not getting the income we have historically. And then, like it or not, what we've experienced over the last couple of years is increasing correlations from investments. So what do we need to do is we need to really solve for how do we spread our risk more effectively? How do we find opportunities that probably don't exist within our borders, think outside of our borders? And how do we find opportunities to increase the income in our portfolio? And I think the way that we do that is we need to expand the number of asset classes. We need to look at international and emerging. Maybe if we have the wherewithal, we should think about some other equity surrogates like private equity or alternative investments. We need to think about other sources of income, areas like high yield, maybe REITs, maybe MLPs. Clearly, they bring some corresponding risk, but the opportunity to pick up incremental yield where we can. And then we need to think about, are there certain things that can be introduced to the portfolio to help buffer some of the volatility? And again, instruments like cash and gold and maybe some alternatives like managed futures might be appropriate things to add to the portfolios. But I think we need to solve for a very different market environment today than the market environment that existed in the 90s.
I imagine here we are in the midst of the coronavirus pandemic. And have you had a chance to maybe examine how a 60/40 portfolio stood up during this time period relative to, say, a globally diversified portfolio where you are looking at these forward-looking models and alternative asset classes?
You know, I haven't recently, but I can tell you I wrote something not so long ago looking at if you took the traditional 60/40 portfolio and you didn't rebalance and you let all the winners ride. I think at the end of gosh, I'm trying to think of the time period of the study. So I might be a little bit long on the numbers, but I think if you let that 60/40 portfolio ride from the bottom of the when we began the bull market March 2009 and let it ride to say December 2018, if I'm not mistaken, the equity allocation alone would have increased to 73%.
Mm.
And obviously, what that says is you're taking on a lot of corresponding risk. If you think behaviorally over the last couple of years, the US markets have done so well. What I've seen from a lot of individual investors and advisors is allocations have been much higher to the US, less to international and emerging. And I think on the fixed income side, a lot of people really haven't been paying a lot of attention other than maybe chasing some of the yield and looking at high yield and REITs and MLPs. So the question is if done in an unconstrained way and if done in an irrational way where I'm chasing return, where I find return, and I'm chasing yield where I get yield, are you in fact taking on more risk? I think categorically you can say clearly you're going to be taking on more risk. So I think it's important to, as you and I often talk about, it's important to start, what are we solving for? Let's go through the planning process. What are we solving for? What's the appropriate balance of these new ingredients that we're talking about in our portfolio to help provide the smoothest ride over time? Because we want to balance, are we taking on too much risk to get the return? Are we exposing the portfolio to too much risk relative to where we need to be? So as much as we're very fond of the fact that we now have a much broader toolbox, I think those tools need to be used in an intelligent fashion.
So as advisors evolve their asset allocation approach, what role, if any, does modern portfolio theory and the efficient market frontier have to, play in any of this, or does it?
I'm a believer that modern portfolio theory still makes sense. In fact, I'm writing a white paper on the topic now, but it certainly does need to evolve since the early days. Poor Harry Markowitz has been criticized for modern portfolio theory not working. I would argue in an environment like this, you're reminded of the value of a diversified portfolio. Diversified portfolios are doing much better than exposing all of your client's portfolio to just owning individual stocks in your portfolio. There's no doubt about that. But as much as modern portfolio theory started with a very simplistic view that you could take individual risky portfolios, and as long as they don't move in lockstep with one another, put them together in a fashion that actually provided higher incremental return and lower risk. I would argue today we need to think about expanding that toolbox. Now, the beauty of today, as much as we start with the negative, the death of something, I would argue the countervailing point is we now have more tools at our disposal. Advisors have more tools, manufacturers have more tools, and a lot of those tools are actually in the form of exchange traded funds. ETFs gives us a very efficient way of getting exposure to virtually every asset class. I can now very efficiently own the emerging markets, international. I can own them in a market cap fashion, which is the way that the markets are initially constructed. Or in fact, I can be a little clever about it, and I can actually introduce certain tilts and biases that I might have in constructing a portfolio. So if I'm looking at the emerging market, for example, I might be concerned that the asset class itself is individually risky, and I might be better served actually looking at a value tilting portfolio. I might look at different market segments, and I can own them in a fashion where I'm capitalizing on momentum that might exist in the market. Or if I'm concerned about risk in the US markets here, I might look at a low vol portfolio because I want to take some of the volatility out of it, or I might want to have more of a dividend tilt to capture some of the return. So I can use these broader tools in a generic sort of fashion, or I can actually use them by reflecting individual tilts and biases just because of the way that they're manufactured today. So the beauty is we do have a much broader toolbox than we did 10 years ago or even 20 years ago.
And so when I think about one of the limitations of the 60/40, I think you've mentioned in the past that correlations among asset classes have been rising and may likely remain elevated in the future. But with all these new asset classes, perhaps there are now more options for having defensive or non-correlating assets in your toolbox.
I think that that's correct. And again, depending on the wherewithal, we now have alternative strategies that some of which are available in ETFs and mutual funds. Some of them are actually better served in their traditional LP structure. There's been a lot of product innovation going on. So some of those, managed futures and global macro are traditionally thought of as defensive assets. I think one of the things I've talked to you about in the past, and I always try to emphasize with clients, we use a different sort of language than most clients really understand. We tend to talk about these strategies, and we assume that clients understand them the same way that you and I do when we have a conversation. I always like to break things down into ways that clients can consume information. And one of the things I focus on is if we think of asset classes in their simplest form and we think about individually what are they solving for, I think of growth clearly is going to come from stocks. It's primarily going to come from our equity allocation. It'll come from large and small and international and emerging. And again, if you have the wherewithal, it will come from strategies like long short equity or even private equity. If I think about where I'm going to get income in my portfolio, it's primarily going to come from my fixed income allocation. But beyond thinking of high yield and treasuries, might we consider things like REITs or MLPs, where again, if we have the wherewithal, alternative credit strategies, there are different ways of picking up income than just thinking of our kind of vanilla sort of toolbox here. And then to your point about thinking about defensive non-correlating assets, which I think can make an awful lot of sense in an environment like this, I think the simplistic way of thinking about it is cash and gold. Do I increase my gold allocation when I know there's risk in the marketplace because gold tends to be a safe haven assets? Do I increase my cash allocation to help buffer some of the volatility? Now, I would argue, and I've had many discussions with clients about this, you don't want to go to cash and try to time the market and sit out the market altogether. We know that historically has not worked very well. But subtly increasing your cash allocation takes a little bit of the risk out of the market. It's not a long-term strategy. It's providing negative real return, but it's attractive over the short run. And then if we have the means to do so, managed futures and global macros are more defensive assets, and they might help buffer some of the volatility along the way. So if we start to think about the role that each one of these investments play, and then we think of what is the optimal combination of that, I think one, we're going to provide better outcomes for our clients, but two, it helps us in describing why we're introducing things to a client's portfolio. And it also allows us to effectively measure, is it doing the job that it's supposed to do in their portfolio? So rather than throw the whole portfolio out if it's not working, maybe we isolate it on, well, our growth portfolio is actually doing what it's supposed to do, but we're not getting the level of income. And maybe we need to think about adjusting our income and either picking up more income or maybe taking more risk out of it. So I think it's a different sort of way of having that discussion about how we build portfolios and how ultimately we try to solve for long-term needs of our clients.
So speaking of how we build portfolios, as we witness the demise of the 60/40 portfolio, we are watching perhaps the rise of models. And can you talk about that being either a positive or negative development, and how advisors might embrace these asset allocation models?
Yeah, I think it's actually a very exciting development. I think over the last couple of years, we've started to see what I refer to as the rise of the models. But they're asset allocation models. And now with this expanded toolbox, these asset allocation models can be total return oriented or they could be goals based. They can include a broader array of fixed income and equity strategies. They can include alternatives. Um, with all the tools that we're providing, we now allow the manufacturer, whether that be a third party asset manager, whether that be the headquarters of a Morgan Stanley or a Merrill Lynch, or whether that be an advisor who has the time and the wherewithal to build portfolios on their own, we've now given them as many tools as possible so they can actually build very different portfolios depending on what they're trying to solve for each one of their underlying clients. So I think it's a terrific time. There's a lot of these models that are coming to the market now. They're very different in shapes and flavors. Many of those are taking advantage of the expertise that a lot of these third-party asset managers have. It takes advantage of their capital market expectations, how they're looking at the world in the next 10 to 20 years. It allows them to select across a broad array of asset classes and strategies to reflect their views and preferences in building portfolios. They can be static in nature or they can be more dynamic. So I think for me, it's an exciting time for an advisor, but perhaps means they need to pivot a little bit to think about what is their role and what is their value proposition. And I would argue for a lot of them, their value proposition isn't building portfolios for their clients. It's in fact dealing with all of the wealth management issues. What's their financial plan? What are their trust and estate issues? Um, a lot of the value of a financial advisor is actually dealing with the volatility that we have in an environment like this, serving as a coach and a psychologist with a client and helping them make the right informed decisions over the long run and trying to help them from avoiding the emotional temptation to get out of the market at precisely the wrong time. So to me, the value of the models is it really frees the advisor up to do what they do best. Leave the investment decisions to another expert. Let somebody else make those decisions on your behalf. It aligns you with your client. You're sitting on the same side of the table with your client. And you now have the ability to tap into the expertise of all of these managers who have tremendous resources dedicated to this process.
So the trickier question for me then is of the models that you've described, I'll say seven, just for a walking around number. How would an advisor go about picking the right model for the right circumstance or right client or right fact pattern?
Yeah, and I think that is one of the switches of the responsibility. So maybe the advisor's responsibility now isn't building a portfolio; it's selecting somebody who can build it for him or her. And I liken it back to the early days of the SMA business. When the SMAs came out, the value proposition of the advisor was, how do I select across these world class managers with all the resources and the expertise? And what did they do? They made determinations based on the firm and the resources they had available. They made determinations based around their philosophy. Does their philosophy align with the way that I look at the world? Is it consistent with what I'm trying to solve for with my clients? They looked at the underlying performance, although clearly we don't want to select based on performance. But they want to have a sense of how do these strategies perform in rising and falling markets. How might they perform in an environment like the one that we're going through today? So I think they would go through a similar sort of checklist as they did in the early days of the SMAs. And it may be at the end of the process, they don't select one model that solves for all. They select multiple models. So I look at total return, for example. Total return, I tend to think of total return models fit on the efficient frontier. There might be 5 models on that efficient frontier, and that might be multiplied by taxable versus tax exempt. Goal space, what are we solving for? Are we solving for retirement? Are we solving for maximizing income? Are we solving for minimizing risk and volatility in a market environment? There could be multiple things that we're solving for. So ultimately, what the advisor is doing is based on a family, they're trying to determine what is the right individual combination of all of these that gives me the highest likelihood of achieving the family's goals over the long run.
So, I mean, as you think about the challenge of an advisor who is trying to manage money on their own with access to whatever tools that they have, and you think about the rise of these models, that person could be at a disadvantage in some respects, given the resources that are available to the makers of models. That
I, I think so. I definitely think so. And again, I think something that you and I have talked about in the past is I know that for some advisors, they believe that is there a potential diminution of my value add if I'm not manufacturing portfolios? I refer to some Cerulli research that I think has really, helped me kind of get my arms around this myself, and that is that although an advisor often believes that their value proposition is building portfolios, I think Cerulli research actually says it's the other way around, that the client really values the advisor as being the quarterback, the one who can find those experts. And they generally expect that expertise to come from somebody else. They expect somebody who has more dedicated resources to be the true expert in building portfolios. The value of the advisor is the quarterback, to know everything about the client's needs and expectations and align those experts, whether the experts in trust and estate or building a portfolio or to understand retirement strategies. That quarterback is really sitting at the center of the universe and tapping into the expertise that exists at their own firms or at firms outside of their borders. But that's where I think the value of the advisor is, and I think that aligns with the way that the client sees the value of the advisor, not necessarily building a portfolio.
Hmm. Well, we recently had on one of our Exceptional Advisor podcasts, Cindy Pagliaro from Vanguard, who discussed some research that they had done at Vanguard called "The Value of Advice," and what they discovered was that clients value 50% of the value that they value is the financial outcome, but 50% is the emotional outcome from the advisor in terms of, am I able to sleep at night? Do I feel comfortable that we're on the right path, et cetera, having nothing at all to do with the performance of a portfolio and more to do with how I felt about the relationship and whether it was meeting my needs in an emotional way.
I think that's right. I would agree with that. And, again, I view that behavioral element as the advisor functioning as a coach. I think of an environment that we're in today, and the temptation for so many clients is to say, I'm uncomfortable with what's going on, and therefore I want to jump out of the market. I want to sit in cash. And as you and I know, trying to time the market is nearly impossible. And what's really difficult is when a client jumps out of the market and they sit on cash, it's getting them back in the market when they should be. And I recall, many clients exited the market in 2008. It was a very uncomfortable environment. Unfortunately, many of those clients didn't get back into the market until 2013, 2014, 2015, where again, we're kind of late cycle and they missed out on much of the substantial run up that had occurred. So my fear is that left to their own devices, clients will react emotionally. And that in an environment like this, it means maybe they get out. And then in other environments, when the market is rising as much as it had, their temptation is I'm just going to keep on doubling down on red, and I'm going to buy, more and more of what has been working, which compounds the risk that they're taking in their portfolio. So I agree that the ability to have those positive outcomes really means that the advisor needs to be that behavioral coach to help client to make logical, informed decisions as opposed to emotional decisions.
Hmm. Let me go back to the models for one tiny second, and it has to do with the institute and its ownership of the retirement management advisor designation, which is providing advisors with the education needed to help folks, their clients, build retirement income plans. Do you have any sense of whether these models are in a place to help advisors do that, or is there more engineering that needs to be done in order to create a model that sufficiently helps advisors create retirement income plans for their clients?
I think there are. And again, I think it really goes to the inputs in the models themselves. And I think one of the things that I'm comforted by is what we have world class asset managers jumping into this space to manufacture models, and they're using their own capital market assumptions. Not to favor one firm versus the other, but I've spent a fair amount of time looking at the J.P. Morgan long-term capital market expectations. They don't assume that the market's going to be the long-term historical average. They don't assume it's going to be 10% equity returns, 4% income. They've in fact adjusted those. That adjustment is built into all the modeling that they develop. And the same would be true with a Goldman Sachs or research affiliates, anyone who has their own capital market expectations. So if we're starting from realistic assumptions of what the future holds, it then allows us to build much more effective portfolios. So I think what you'll find with the manufacturer models, some of those will be income oriented, which will help in retirement, help us get to retirement. And then something that you and I have talked a lot about is help them through retirement. So, it's not enough to just develop a model that helps somebody to get to retirement. We know that people are living longer, more productive lives in retirement. How do we help them through retirement to live a lifestyle that they're comfortable with? So, the value of the advisor is to get the right inputs in the model. The value of the manufacturing is to make sure that they provide the highest predictability of the desired outcome that they're striving towards. So it really is a managing of how do we use these tools that are now at our disposal to help us achieve those long-term retirement goals or any sort of planning goals that we're thinking about.
Hmm. So I have another curveball for you, which is I had a chance to interview Robert Merton for a interview that will appear in the upcoming issue of the Retirement Management Journal. And one of the things that he said that was most interesting to me was this notion that target date funds have been the wrong product at the wrong time for the wrong demographic. That building portfolios based solely on time horizon may not have done may have been a safe harbor, but may not have been in the best interest of the people using them to save for retirement. Any thoughts on that by chance? I didn't want to put you on the spot, but it's top of mind.
Yeah, Bob, as you know, we've actually talked about this on the editorial advisory board. I think the first generation of target date funds, in my view, were pretty crude, and they're pretty crude because you're on this glide path that assumed that everyone would be the same, everyone would retire at the same age, everyone would, essentially live, whatever the actuarial assumptions said. And again, I think that was the first generation. I think. We've talked about it at the editorial advisory board, and I do know that there are more evolved target date funds out there that have moved beyond this cookie cutter sort of glide path. And some of those target date funds are now, again, thinking about this broader set of asset classes. Some of those are more strategic and tactical oriented, where they can make adjustments as things change over time. And I do know that many of them are looking at more current and updated capital market expectations to make sure that we're solving for the right things over the long run. So I think clearly first generation, perhaps a little weak in thinking through the nuances of the marketplace. But like everything else, I think products evolve, especially as the demand from the consumers demand that we need to be more forward looking and we need to anticipate choppiness in the markets and a longer glide path or a longer time horizon than I think the original sort of work had suggested. So I'd like to think that many of them are evolving, but I think a critical eye in looking at target date funds or any sort of solution is always a wise thing. And again, I encourage advisors. I think the nature of an advisor is to, in many respects, be the advocate for those clients to make sure all the things they're invested in make sense and make sure that there aren't more advanced sort of ways of looking at these things. And I think target date funds are definitely an area that has warranted a little bit more evolution. And I think some of that is starting to come. But I would never disagree with Dr. Merton on anything that he says.
Fair enough. Anything that we haven't touched upon that our listeners should hear before we wrap up, or anything that you want to double back on that we didn't cover adequately?
Well, this has been great, Bob. I think we've covered a lot of ground. Hopefully we get the chance to do this again. I would just say that it's worth taking a look at these new models. I'm very excited about it. I think it's the next wave for our industry. I think it shifts the value proposition to where the advisor really can help the client the most, and it leverages the asset managers who have tremendous resources dedicated to this place. I don't think in any way it diminishes the value of the advisor. It just allows them to focus on what they do best and really serve as the quarterback to the whole client relationship. I'd also offer, just given the environment that we have here, that the value of an advisor is so much more than building portfolios. It's really, keeping our clients focused on the right thing, keeping them focused on acting rationally or as rationally as they can, and avoiding that emotional impulse that we all suffer from. So again, the value of an advisor is so important, especially in extreme environments like this. And I applaud everyone for all the work that you do in serving your clients in these challenging times.
Well, Tony, thank you ever so much for being a guest on the podcast. With hope you'll become a regular a guest on the show as well.
Thank you, Bob. Always a pleasure.
Thank you for listening to our Exceptional Advisor podcast. My guest was Tony Davidow, the chair of the Editorial Advisory Board of the Investments and Wealth Monitor. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit our website at investmentsandwealth.org to learn more about our certifications, conferences, online learning, and continuing education programs.